Gold prices have just spiked vertically. We're seeing them surge past $4,300 an ounce. That's a historic jump, over 70% in 2025 alone. And, this just defies the classic financial gravity. High real interest rates should be pushing down non-yielding assets like gold. It feels like the physics are broken.
They absolutely are. I mean, the conventional relationship between gold and interest rates is structurally broken. But this isn't just random speculation.
Yeah.
This decoupling is being driven by coordinated record-pace buying from central banks, mostly in the global south. It's a strategic preparation for a future where trust in the U.S. dollar is, well, it's just eroding.
This is neural pulse. Let's analyze. Okay, let's unpack this. We should start where the pressure is most acute, and that's the Indo-Pacific. China's Justice Mission 2025 exercise, right at the end of December, it confirmed a huge shift in strategy. It's not about practicing an outright invasion anymore. It's about a physical blockade.
Exactly. And the detail that really stands out to me is the makeup of the fleet. This wasn't just the PLA Navy.
Right, it was the Coast Guard.
14 China Coast Guard vessels were at the core of the operation. They rehearsed law enforcement, things like inspecting and quarantining civilian ships. It's a very clever way for Beijing to apply maximum pressure while staying just below that threshold of open military conflict.
And that show of force was met by, well, a massive response from the U.S. 3 carrier strike groups.
The Lincoln, the Vinson, the George Washington.
All there. An unusually heavy presence, which tells you just how seriously Washington is taking this law enforcement exercise.
They have to. They absolutely have to, because this maneuver directly targets Taiwan's single greatest weakness.
Energy.
Energy. Taiwan imports over 97% of it. And if you look at their reserves, they've only got about 11 days of LNG at peak usage. And that fragility is only getting worse with the 2025 shutdown of the Monshan nuclear plant. We don't expect a restart until 2028, maybe later. China knows exactly where to squeeze.
But doesn't this come at a huge economic cost for Beijing? I mean, their own economy is slowing down. GDP growth is only forecast at, 4.8%. Why risk more pain by threatening global supply chains?
Because for the CCP, the political goal of reunification now outweighs the economic logic. It's a priority. And this willingness to take a hit also works as an asymmetric response. The U.S. applies tech, pressure export controls, tariffs.
And China hits back where it hurts the global system most.
Precisely.
So if I'm running a shipping company in Singapore and I see these exercise zones choking off the LNG routes into Kaohsiung and Taichung, what does that mean for me, for my bottom line?
It means the status quo is over. China is actively turning the Taiwan Strait from open waters into a de facto internal sea. And for that CEO, your war risk premiums, the cost to insure your ships, they soar instantly. This isn't theoretical. It's embedding cost-push inflation into every single container shipment right now.
And that pressure is forcing major financial realignments. The biggest tremor we've seen from that is definitely coming out of Tokyo. Let's drill down on the numbers here. December 19th, the Bank of Japan raises its key policy rate from 0.5 to 0.75%. Now, that sounds tiny, but it's the first hike above 0.5% in 3 decades. We saw 10-year bond yields briefly top 2%.
The driver here is pretty clear. It's persistent, painful domestic inflation. It's running above their 2% target, and it's made worse by years of a weak yen driving up import costs.
So there's political pressure.
Enormous political pressure over falling real wages. But there's a second objective here, too. A weaker yen draws criticism from Washington, especially from the new administration. So strengthening it a bit helps diffuse that trade tension.
What's really striking, though, is that Japan is tightening policy when its economy isn't even close to being overheated, not by global standards. Why now?
It signals a desire for what they call normalization. Japan is using this as a chance to force a kind of corporate metabolism. They're using higher rates to finally cull all those inefficient, debt-addicted zombie companies that only survived because of zero interest rate life support.
So if that's the domestic goal, what's the global consequence for the rest of us?
It triggers the unwind of the yen carry trade, one of the biggest financial events of the decade.
Unpack that.
Okay, so for years, investors borrowed yen for basically free zero interest, and then invested it in higher-yielding assets like U.S. Treasuries.
Right.
Now, with Japanese rates rising, you have to pay that loan back, so you have to sell those U.S. assets to get the yen you need. That massive sell-off puts huge upward pressure on the U.S. 10-year yield,
which is sitting around 4.17%.
And that pressure coming from outside the U.S. dramatically increases the risk of a U.S. recession in the next year.
So this rejection of cheap money in Japan connects directly back to that deep suspicion we're seeing everywhere about the future of fiat currency itself. Which brings us back to gold. Let's circle back to that surge, $4,300 an ounce. The central bank data is the key. They are buying 585 tons per quarter. That's nearly double the historical average. China, Russia, the global south leading the charge.
The context is a total loss of trust in the U.S. dollar as a safe haven. That was solidified forever in 2022 when Russian foreign reserves were frozen.
A watershed moment.
Absolutely. This gold hoarding is a strategic defense. It's a tool for sanction evasion. And it's only accelerated by the size of the U.S. fiscal deficit. I mean, the CBO is projecting a $439 billion deficit in just the first 2 months of fiscal 2026.
Okay, but let me play the skeptic here. Gold pays nothing. We're in a high-rate world. Why would a central bank prefer a non-yielding asset over a U.S. Treasury that pays 4, maybe 5%?
Because they are prioritizing capital preservation over marginal return. They're looking past today's rates. They anticipate the inevitable solution to that crushing U.S. debt. And that solution is currency debasement. It's what we call financial repression.
Just define financial repression for us, simply.
It's when a government deals with its debt by intentionally keeping real interest rates. That's the rate of return, minus inflation in negative territory. You're paying back old debt with new devalued currency. So by buying gold, these nations are betting the dollar will be deliberately weakened. They'd rather hold something real than something that gets eaten away by planned inflation.
And what's fascinating is that this warning signal from gold is running in parallel with another indicator, falling oil prices. Brent crude is in the low 60s a barrel, mainly because of China's slowdown.
And that combination, gold rising, oil falling, is a textbook signal for a pre-stagflationary environment.
How so?
Gold is warning of future inflation, of eroding purchasing power. But cheap oil is reflecting economic stagnation that's happening today. It's a very dangerous combination.
So what's the actionable takeaway for a decision maker listening to this, for their treasury strategy?
The dollar is shifting from being the only choice to being one of many choices. And that means corporate treasuries have to adapt, moving a portion of reserves into non-sovereign assets like gold, and yes, increasingly Bitcoin. That's no longer a fringe speculation. It's becoming standard risk management.
And this move away from the dollar is also showing up in very real resource conflicts on the ground, specifically for nuclear fuel. Let's talk about the Sahel. The alliance of Sahel states, that's Niger, Mali, Burkina Faso, has really tightened its ties with Russia, and the result. In December, Niger's military regime halted all uranium exports to France. They nationalized key mining assets. That's a huge blow to companies like France's Orano.
It's a devastating structural blow. France gets 65% of its electricity from nuclear power. Niger has historically been a key supplier, maybe 15 to 20% of their imports. And Russia is just brilliantly exploiting anti-colonial sentiment. They're basically trading security through the Africa Corps, the Wagner successor, for direct access to uranium and gold.
The irony is just painful. Europe pivots back to nuclear to get energy independence from Russian gas and oil.
Only to find that its nuclear fuel supply is now falling under Russian influence anyway.
Exactly. And the linkage goes beyond Niger. This instability is spreading east, into the Sudanese civil war. That internal route from the Sahel through Sudan to Port Sudan on the Red Sea could become Russia's corridor of autocracy.
The way to extract resources with zero Western oversight.
Right. And we have to mention the rising concern about Iran potentially getting access to Nigerian uranium through these new channels. That raises serious proliferation risks.
So the consequence for industry is clear. Uranium spot prices stay high, or they surge. European power costs go up, which hurts manufacturing even more. And regional security deteriorates, which raises the risk of terrorism spilling over into those coastal West African nations.
From resource choke points, let's shift to the pressure we're seeing at sea and in the invisible digital world. In the Middle East, the Israeli-Hezbollah ceasefire deadline passed with no real demilitarization. The IDF is reporting over 2,000 violations. The risk of a large-scale conflict is rising. And at the same time, Houthi attacks in the Red Sea continue. Maritime trade growth stalled to just 0.5% in 2025. The Suez Canal is still functionally disrupted.
The context here is Iran, and its proxies are taking advantage of a shift in U.S. focus. Yes, there's strong support for Israel, but a reduced direct military footprint because U.S. assets are needed elsewhere. They see that as a green light to impose costs on the West by keeping the pressure on that Red Sea choke point.
But here's the counterbalance, right? Despite all that risk, Brent crude is still in the low 60s. The China demand slowdown is still outweighing the Mideast volatility.
It's a moment of false security. It's an incredibly unstable balance. Any major incident, A closure of the Strait of Hormuz, for instance, could send prices past $100 a barrel almost instantly.
Now let's connect this physical maritime risk to its invisible counterpart. We're seeing China's state-sponsored group, Volt Typhoon, detected deep inside critical U.S. infrastructure. Power grids, water systems, ports.
And their goal isn't just spying, it's what we call pre-positioning for disruption. They use these living-off-the-land techniques, hiding in plain sight using existing system tools to evade detection for months, even years. CISA is right to call them time bombs.
And the linkage to the physical world is direct. The cyber activity is the invisible part of the Taiwan blockade rehearsal. A synchronized cyber attack on U.S. ports or power grids during a Taiwan crisis would just maximize U.S. deployment delays. It's the digital side of an A2AD strategy.
It's an integrated war plan, two wheels of the same machine. A2AD, of course, is just making it too costly or too slow for the U.S. to intervene, and the consequence for your business planning is severe. This isn't an IT issue anymore. Cyber risk is now cyber-physical risk. Meaning your business continuity plan has to account for a physical shutdown caused by a geopolitical cyber attack. And here's the critical part. Because these attacks could be deemed an act of war, your cyber insurance policy probably won't cover it. This becomes a pure balance sheet survival liability.
There's one final front to mention, one that's draining U.S. deterrence: Operation Southern Spear. Since August 2025, Washington has ramped up naval pressure in the Caribbean against cartels in Venezuela, using high-value assets like the USS Ford Carrier Group.
The strategic trade-off here is unavoidable. When you divert top-tier naval assets for drug interdiction and border security, no matter how necessary it feels for domestic politics, you severely stress the readiness of the entire fleet, and you compromise U.S. deterrence in much higher-stakes theaters like the Indo-Pacific and the Middle East.
So to summarize, the world has entered the execution phase of what looks like an irreversible structural fracture. We have to stop talking about the ambiguity of uncertainty and start dealing with the cold, hard certainty of risk.
We'll leave you with 3 key takeaways for your planning. First, supply chain disruption around Taiwan is now a premise of doing business. It's not a risk-you model, it's a baseline assumption. Second, asset allocation have to prioritize asset defense real assets, like gold over chasing interest return. That's because of the declining trust in fiat currency. And third, your cybersecurity investment is a balance sheet survival issue. It is not an IT department expense. You know, the ancient map makers used to write, "Hic sunt dracones, here be dragons," on the unknown parts of the map. That warning is profoundly applicable today. But the dragons aren't hiding in some unknown territory. They are powerful, very visible actors who are intentionally creating chaos in the known, globalized system.
Neural pulse. Clarity in a complex world. See you tomorrow.